Alrighty, traders, good afternoon, good morning, good evening, and welcome to the AAA session here on this beautiful Monday morning. Actually, afternoon. Sorry, I'm a little bit behind time. Alright, good afternoon, everyone, and welcome to the session. We've got Tyson and Chris in the room today. We're going to be talking about the markets and what's moving. We definitely don't have a whole bunch of fundamentals out this week, but we do have fundamentals. We'll be talking about that. I know Tyson's got some stocks that he's going to talk about today as well. We're also going to talk about the dollar index, gold, silver. I know there's a lot of chit-chat going on regarding that as well. We're definitely going to have conversation around that. Now, we've got 30 minutes to go ahead and have discussions around all these different things that are moving the market today and this week. So let's go ahead and get started right away. In fact, let's go ahead and introduce the panel for today. And it's Chris and Tyson. Chris, how are you doing today?
I'm doing excellent, Gary. Happy Monday, everybody. Nice to be here.
Fantastic. Tyson?
I'm doing good. Excited. Actually, Gary, you know what? We have a jam-packed week. We've got 130 of the S&P 500 companies reporting earnings this week. We've got the stimulus package, deal, no deal, what's going to happen. We've got the Fed announcement. We've got some Aussie inflationary data coming out tomorrow. This is going to be an exciting week, Gary.
Yes, it is. It is.
I know you're tempering your enthusiasm, but I got to tell you, we got to wake up because this is going to be a good one.
Absolutely, absolutely. Well, my focus this week, guys, is just really taking a look at obviously the Aussie. We've got Aussie GDP coming out this week on Tuesday. In fact, Tuesday evening. So it starts off with Tuesday evening. We've got Aussie data coming out. Then we've got the Fed coming in on Wednesday. Chit chat about the Feds. We've got a bit of the Thursday data coming out as well. Also, GDP coming out on Thursday. I actually spoke about it this morning. There we go. We've got European GDP coming out, and then we've got US GDP coming out on Thursday. So we do have some data that's going to move the market. Absolutely, there's no doubt about it. I think the main focus is going to be on what the Fed's going to say again on Wednesday. How that's going to be able to pivot around the different directional bias that we have right now, and specifically talking about the dollar index. I don't know if you guys noticed, but we've seen some downside moving dollar index, but I'm still excited about the possibilities of a divergence setup, a bullish divergence setting up on the dollar index, still anticipating some rally in dollar. What is your guys' view on that?
Oh, I agree. I mean, it's a broken record. I'll let Chris kind of take it, but we've been saying this now for it seems like a month and a half, 2 months, 3 months. This is going to be one of those trades, and I think this is the whole theme throughout this session is patience. That patience will eventually pay off. I've been talking about this. We've all been talking about this. Time is not different. It feels different. It kind of, when are these going to end? We don't want to fight this. And I think, Chris, Gary, you guys have been doing a good job writing like the momentum and different things, different strategies like that. It's hard, though. It's hard to turn those. For me, it's hard to look at some of these charts and say, man, it's going to continue. But the students that have been doing that have been making a lot of money. Just be prepared to pivot when that pivot happens.
Yeah.
Right.
And I was just going to say, Gary and Tyson, what gets me excited about the technical setup is how the dollar's been falling. It's one thing if it's like really efficient, really, kind of normal. Every candle that gets pushed, that's dollar weakness or subtle dollar weakness. But like this has been pretty dramatic, pretty quick, pretty inefficient dollar weakness. So we've seen, the last 3, 4, 5 weeks, dollar Swiss that have been bearish. We've seen the last 3, 4, 5 weeks on euro dollar. When we're leaving these giant candles, like last week's candle on the euro dollar was huge. So, I'm already looking at levels on euro dollar, like between 120, 122, looking for levels to start calling some tops, look at some resistance, and then see how this thing balances out. Dollar index as well. If we just keep falling to these levels without having much of a pullback, then it would make sense for me that August becomes a transition month. So my suggestion to traders that I was looking at doing in my weekly outlook this week is if we've seen range-bound currency pairs and they're starting to get into August with breakouts, we want to follow those breakouts. If we see trends that are going into August that lead to these extremes and these divergence levels, those are the trades we want to start looking for tops and bottoms. So I think for the dollar index, it would make technical sense that the way it's been falling, how fast it's been falling, is going to be one of those divergence setups where it's a nice technical rebound.
Well, I'm going to go back and take on Tyson's point there about being patient, and I'm going to go to the dollar index and just show traders what the dollar index is doing right now. why we are looking at the dollar index so intensely, because it's sitting at these crucial levels. It's trying to break through. I still don't see this as a confirmed breakout, but we're trying to break out of this upward channel that we've been in. But we are looking for some correction. We've got this downward falling wedge right here. So we're looking for some upside move. It moves into, let's see here, 1, 2, 3, 4, and 5. Yeah, so it's 1, 2, 3, 4, 5, and then break out to the upside. So we've already moved. This is the fifth final move in this wedge, and we're expecting a six-way breakout right here. Now, if you look at the price and momentum right here, we're still seeing divergence setting up right here, which means that we do expect price to move down lower. So we got down to liquidation level right here. We're expecting price to move back up again. So I'm expecting, and this is where patience comes in, right, guys? I mean, patience is very, very important when we look at these type of trade setups, because the Euro New Zealand dollar was another good example of traders that were patient on this. It's actually now at the support level at about 71.82. And I said, let's be patient, be patient. It did have its rally. Then it went into sideways motion again, and then broke out again. I'm looking for price to move up to at least to looks like 76.80, 76.84 before we see some sort of pullback. But if I look at this whole thing right here, it's range bound. We're at the bottom of the range. We got to start moving up. And the same thing goes. You can see almost like a lookalike here on the pound Aussie. Look at this pound Aussie. We've been talking about rallying on the pound Aussie. It takes a lot of patience for traders to sit this one out and wait for their breakout. It's starting to happen, and traders are starting to see the money in the trade. So patience is absolutely key. When you see these levels of support and resistance, stay patient on that. Don't get nervous about that. Don't be quick to make quick decisions without proper confirmation on your technicals, because that's what's happening on those pairs, and that's why traders are making such good money. Now, flipping over to something else. Talk to us, Tyson, about stocks that you're keeping your eye on this week as well.
Yeah, and so I actually want to pivot this. This kind of goes back into the dollar. Before I get the stocks, I want to talk gold for a second, because I'm doing some analysis on gold right now, and it actually ties into some of my plays in stocks and risk assets. I'm doing some analysis on the gold market. What I'd love everybody to do is go out there and do some analysis on what happens from the July peak in an election year over the last three elections, 2008, 2012, 2016, the July high, what happens the next 12 months after that? We see at least a 20% sell-off from the July high. Are we sitting at the July high right now? Yep. What happened in 2016? From the beginning of the year until through July, we had about a 30% rally. Same exact thing. And then we saw about a 18 to 20% sell-off from the July high. So same exact things happening right now. We have a lot of the same makeup. So I'm bearish, guys. I think I'm bearish because, again, you go back and you're like, oh, man, wait a minute, Tyson. The world's kind of crazy right now. How can you be bearish on gold? Well, go back into the charts and look at when the world was crazy back in 2000, 2001. What did gold do? It sold off. Go back into the charts and look at 2008, 2009. What did gold do? It sold off. And so, again, it's a hedge, but it's also, people forget that it's an inflationary commodity currency type of asset, or it's an inflationary asset. And if we go through times of struggle in the economy, that means that inflation is going to be dampened. And if inflation is dampened, then we're going to see a sell-off in gold. Now, this time is a little bit different, and this is where I will say it's a little different because we have some social unrest that we haven't had before. So gold is not only being played, not only be bid higher because of the inflationary aspect, but it's also being bid higher as a true safety play. I'm not going to go out there on a ledge and say that there's going to be someday where we have to, transact in gold bullion and gold bricks. But I'll tell you, it does feel better to have some hard asset gold on hand than not having that asset on hand. So there's some of that in there too. But I am not a big fan of gold. I'm not a big fan of risk assets right now. With that being said, I would be a seller of gold. It's not my favorite short, but it's very, very correlated to the Aussie, which is my favorite short. And so so I guess in an ancillary roundabout way, it is probably one of my favorite shorts right now. because the correlation of the gold chart right now and the Aussie dollar chart right now is ridiculous. It looks about the same right now over this big run higher. The stocks that I love, there's a couple stocks that I'm playing right now. I talked about this in the last couple of weeks. And I'm not going to come off this. FHN, which is First Horizon, had a nice bounce from 2 weeks ago from when I originally talked about it. It bounced up, almost got to that 10 level, came back down. Now it's sitting around another good level to start buying at. You can play this range. This is a really good stock that I like long term. Great financial balance sheet. TAP, TAP. I love this stock long term because it's play on the consumer staying at home even longer. And if they don't stay at home even longer, they're not drinking, people aren't drinking more beer at home. I think they're going to go out and drink more beer at bars. So I like that play long term. TAP. However, I'm hedging my long positions with puts in the market. I am buying insurance on my portfolio. We have gone through a hurricane, but we're still in hurricane season. With the election, with everything that's going on with COVID. And I would never buy a house in Florida without hurricane insurance or without flood insurance or without insurance. I'm not going to go long stocks without insurance. So I like buying puts in the S&P 500, the SPY, and I like buying November expiration puts because I want to get that election response. If Biden wins, I don't want to get political, but if Biden wins, I see a massive flush down in the stock market. And I think that could happen. And I want to be long puts in the S&P 500. If that does, so here's a quick trade. I can buy the November 322 SPY puts. Go out to November, buy the puts at 322 strike for $18.35. My target is $37, so I'm looking for a double on that. My stop is $9.25, so I'm willing to risk $9 or so for an opportunity to make $18.50. So it's a 2-to-1 trade, and I think the payoff is pretty good. But what it also does, even if I don't make money on it, even if I lose money, I still have my long stock, so it's just kind of a hedge in my portfolio. So that's the way I like to play it. So I'm bearish.
Right.
I'm bearish. Let's just put it that way. I'm bearish on all risk assets. But honestly, let me just be full disclosure, guys. I've been bearish and I've been wrong. But you know what? I think it's going to be one of those patience, and it's going to be I'm early, but I think I'm eventually going to be right. And if I'm not right, then you know what? That's not that big of a deal because I have other positions that are making money. I'm just not making as much money, if that makes sense.
All right, well, that makes sense, Tyson. And just your views on your Aussie US dollar trade. Are you still short on Aussie US dollar, or have you started cutting your positions?
No, I'm still short, but here's the deal. We did last week. We put in a technical. We broke above a level that I was hoping we would hold, and we didn't hold that level. So what I did in my trading room is I positioned traders, and I said, hey, here's the deal. I'm staying in my trade because I'm not over leveraged. It's not I don't love being in a drawdown trade. However, I don't know if we're going to get the turn here, or we might see a pop higher. There's kind of a gap that was created about a year and a half ago that we could go test, and it's right around this 127 extension. But 73.50 is where I think we could go up to. So I'm not going to add to any shorts right now. I'm staying in the position I'm in because we could turn here, and I don't want to miss it. But if we do go up to 73.50, that's where I want to add. And my target, I've lowered my target because I think that the longer we stay in this massively overbought territory, the bigger the move's going to be to the downside. And my overall target's now down to 61.50. So I think we could see a massive flush. So I'm still short. I'll add if we get to 73.50, and my target's 61.50.
Okay. Well, I've pulled up the chart right here, and there's some saving grace here, if you can call it. I'm seeing still the divergence level holding. We had new highs, and we've got the oscillator still showing a downside turn right here. So we've got new highs and lower highs on the oscillator. So definitely divergence still in play. This is another be patient type trade where you're adding in small positions, locking in, and then you're looking for price to eventually go ahead and turn around to the downside. And I think we're going to have it, Tyson. I think this trade is going to be one of your trades where when it pays off, you're taking off a couple of months just to recover. All right,
yeah,
from all stress.
That's exactly it. It's not fun, right? This is one of those trades that isn't fun, until it's fun, but it can go a while before it actually becomes fun. But then once it actually happens, it's like, wow, that was good. I'm glad I held out. But I'll tell you, I say this in my trading room a lot. The market has a tendency to move in illogical direction for longer than a lot of traders can stay solvent. But it is our job to make sure we don't over leverage and have over expectations or too high of expectations on any trade. We got to make sure that we're in the move when the move happens. We can't over leverage and get wiped out of a trade and then watch the market go in our favor.
You know what? My thought is this, and Chris, you can go ahead and chime in on this as well. But my thought is this: I'd rather go ahead and have a slightly more drawdown on a trade that I'm holding, than keep chopping away on your equity by taking losses. You're trying to get in and out, because now you say, oh, now it's going, get in. Oh, no, it's not, let's get out. Oh, it's going now, let's get in. Oh, it's not, let's get out. I don't like that type of trading. I'd rather go ahead and look for significant levels of support and resistance and say, hey, if I get a defined break, a confirmed break below those levels, I'll start cutting my losses. But up until that point, I'm going to hold on to this trade until the market goes up to where I'm expecting price to move to. So it's looking at a long-term outlook on the market and using those significant lows and significant levels of support and resistance to identify whether the trend is bullish or bearish, but not getting in and out. And look, I understand there's some trading strategies that you may have that you want to get in and out, because if it turns around and goes in the opposite direction, you know what, you don't want to be in that trade in any case. But in most cases, the way the markets are moving right now, it's like it's really taking long to confirm that support or confirm that resistance. And so getting in there and putting your stop losses far away where it really needs you to take out a significant level of support is to me a better option right now for trading, because of the way the market's moving at the moment right now. Chris, what do you think about that?
It's not a fun way to trade when you're going through it, but it's a balancing act for me. Would I rather go through the emotional cycles of in and out, or would I rather go through the emotional cycles of knowing that I'm going to have a little bit of a drawdown, but I'm going to be patient, I'm not going to over leverage, and I'll be in the move when it happens? And I'd rather do the latter. I'm with you, Gary.
Yeah, and I think I've got so used to using like target trading as one of my primary strategies that I trade. Using that, and there you add on positions, and you're used to staying in these drawdowns. As long as those drawdowns aren't significant, that it's starting to affect you emotionally, because it's now a lot more drawdowns than you were hoping to take on and what you should be taking on. So as long as you keep that controlled, you control your emotions through this period of sideways ranging.
So I'm going to make sure that my microphone's on, guys.
Sorry. Yes, we can hear you, Chris.
No, look, this conversation is, I think, what a lot of traders have to decide on. I think what we're really talking about here is our style of equity management. The last couple of weeks, I've been really hitting hard, like, hey, when we get into the middle of August and go into September and get into the election, I want to have cash at the ready. I want to have margin available, and I want to be ready to put that money to work for me. And some of the positions that I'm in, look, I love the Aussie dollar. I think it's going to be a great short, and I'm in at 70.20, and I'm looking to get in right around the same area Tyson's talking about, around 7,300, 7,350. And I think, look, it's a medium term, small position, so I'm not necessarily concerned about like where the high is. My target's more conservative to the corrective side. I mean, I'm going to basically just kind of test some levels, take it down to a safe profit level like 6,700. My pound Aussie, I've been in since 8,000, 7,900. We had a low last week. It's starting to shoot up to the upside. I'm conservative talking about like 8,150, 8,200. Aussie CAD, I'm conservative towards like 9,200. I mean, we've had all these good levels, but Gary, you made a great point. Like, if you're talking about the willingness to have multiple positions, here's my approach. I'm willing to take multiple small positions and let the market prove that you're right. Let the market prove that it's a confirmation that you've been looking for. And then you add a little bit more. And so what turns into, instead of having one position that's either make or break or I win or I lose, it's take that position and divide it into 5, divide it into 10, and just take like little small chunks. And what I tend to do is when I am proven right on a trade, I will build up a small test position into like 5 or 10 entries. But it's 5 or 10 entries that, very few of them are on the losing side and most of them are on the winning side because we have these big levels identified. So, for example, if we take the Aussie dollar from 7,100 down to 6,700 or Tyson's target at 6,100, imagine how many great trades you can add to it as opposed to adding on the wrong side. Adding in. Granted, you're going to eventually find where the top is and you'll make some money. But what, in my experience, the stress has been you're adding more and more and more and heavier and heavier and heavier to those losing directions and not to the winning directions. So that's really been my change over the last couple of years is I'll test with some small positions on the losing side, but then be willing to add more on the winning side. And so it's still, you have really nice wins, produce a lot of profit. And you again nurse the drawdown a little bit better than before because the drawdown now is small trade size, really conservative percentages, really conservative dollar amounts, and then you add to it when you're in the right side of the market. So that's helped me a ton. I don't know if that helps traders out there that are listening, but for example, technically, we'll always go back to the technicals. Aussie dollar has 3 monthly targets in a row. Aussie CAD has 3 monthly targets in a row. Most of these Aussie pairs are so ridiculously overbought or oversold on a technical level that they're going to correct. So we've been talking about this for weeks. It is taking longer, but as we come out of this month, which Tyson, there's so much stuff, like you said. We have another major earnings week. We have the stimulus bill, which is it's back and forth right now between the Democrats and the GOP. I saw that they're considering reducing the amount of wage coverage before this goes live, and they have until the end of the month to do it. So we had this entire week to see some 11th hour deal from Congress. And then we get into August, which, like I said, if we have breakouts, the market's going to trend. But I'm right there with Tyson. Like, I think that it's a good time right now to get your margin in order, get your equity management in order, and get ready for a lot of wild stuff coming over the next 5 months. And know that there will be a ton of opportunity. But I would rather be having the cash on hand to apply in the markets as opposed to be cash positioned right now, or to be margin position right now where it's like you have very little flexibility. I want to be moving on whatever's taken off. So, again, we go back to the technicals. I think gold is a great opportunity to look for shorts. I don't want to do it just randomly. I don't want to. I've never actually seen that correlation, Tyson. We talk about that July-August high, but I just
looked at that and I was like, well, there's something something there. And again, we can't always draw that correlation because we don't always have the election event. But right now, what's interesting is I'm doing a lot of analysis on how asset classes respond between August and the end of the year in an election year. And what I really want to know is I want to know how assets respond between August and the end of the year in 2008. And the reason why, now I want you guys to understand, I'm drawing a correlation from 2020 and 2008 because those are 2 years in my mind that are seared in my mind that history books are going to be written about. We can't say the same thing. 2016 kind of because we had Brexit and we had Trump and all that. But here's the difference. Brexit and Trump, after the initial shock, after 2 or 3 weeks, things kind of normalized. This is different. 2008 and 2020 is different. This is going to be a lingering effect for years and years, just like 2008 was. So I think we have correlations or similarities there. So what I'm doing is I'm kind of looking at different asset classes to see how they responded in that similar environment. And I'm not saying that we're going to get the same response. Like I was doing analysis on the Aussie yen. Aussie yen fell 45% from August to December. I'm not saying we're going to get those type of responses, but I think we could get something similar because it's a similar makeup.
Yeah. So
hey, can I say something real quick, Chris, on what you were talking about with adding to small positions on the losing side, right? Kind of doing that leveling in.
Yeah.
And then being a little bit more aggressive when you get that directional bias. What I love about that is so I look at that as I've been doing this for 19 and a half years, and so I'm going to use my expertise to kind of level in at those key areas manually on a trade like the Aussie dollar. When we start to finally get the evidence that we're going in our direction, the way that I can get out of my own way and allow it to really capitalize is that's when I should turn on my robot like Momentum Max, like Direct Trade, or something that's going to really just capitalize and just leave it on until we hit those targets. So right now, kind of trade manually small. Once we start to get the confirmation, turn on a robot to kind of get out of your own way and make sure you get all the move.
Yeah, and those profits will most likely be much better and much less stressful just letting the robot pick up some of those trades, because it's the logic that you've been waiting for, right?
Yep.
I mean, that's the thing, is traders are smarter. I mean, traders know that there are certain price patterns to look for. There are areas in which, heavy loads of sellers and buyers will be. The market makers know that too. I mean, the markets are going to move in and around those levels, and I think that's also why the markets take longer to fulfill some of these big patterns. Look, everybody can see that the Aussie's overbought. Right? I mean, technically, from a technical standpoint, which Forex market, it's all about technicals. From the technical standpoint, it's so overbought technically. So why does it keep going? Why does it keep drifting? Well, because at some point it's going to reach those thresholds that traders aren't comfortable holding. And that's why we had 2 flash crashes back in March. That's why we've gone to these extremes where it's like we have shallow pullbacks, we have 3 monthly targets. That rarely happens. But when it does happen, we know that historically speaking and technically speaking, they're going to balance. But as Gary said, it's going to require patience. So if you position for that patience, it makes it a lot easier. And then when you're getting the confirmation that you've been waiting for, now you can turn on your robots to take the trades in that direction, set the destination, set that price target, and let your robots help you trade. And also you can manage that little chunk position they've been taking too.
Yep, absolutely. And guys, speaking about exactly what you guys did there, I've taken 2 things, Right Trader Max and Fibonacci Power Pivots. And we went actually in class, we had a live class on Wednesday last week, and we took on 3 currency pairs. I think it was the Pound Aussie, Euro Aussie, and then the Euro CAD. I'm not 100% certain, but I think those 3 currency pairs. And what we did is we just found a support or resistance, and we said, okay, at those levels, this is what we're going to do. We're just going to buy only, sell only, and we're going to use that system. And what we did is we used what we call our go-to strategy, right? We geared it down to a 15-minute time frame, and we said when the market shows that we are above these levels, we're just going to keep buying. And we're up 4% just on that alone, just watching 3 currency pairs. On Right Trader Max, what I've done Right Trader Max, I've gone to fixed lot sizes, so I can add, especially the Pound Aussie, fixed lot sizes. Put my stop loss really far away. Fixed lot sizes, look for a target to the upside, and say above this level, above this support level, I'm just going to go ahead and buy. But I don't just buy. I buy with 5 trade increments, which means that I'll put in 5 trades every time I see a good place to buy at support level. And so what it does is when Right Trader Max is in a buy position, it puts in these trades in slowly, and if it starts escalating, starts moving north, it's going to actually start picking up some more additional trades in the direction of, like Chris says, on the right side of the trend. So using automation, but using technical analysis with automation, it really is very helpful, because when you find these levels of support and resistance, you can't be around the computer to add these positions all the time, and sometimes you're going to miss out the best places to buy in or sell at, right? So what you do is use automation at these levels to go ahead and level you into the position. Another trade that is very, very key right now that I love right now, and I'm watching very closely, I'm already starting to add in, I've got 3 positions already in on this, is the Pound Swiss franc. I don't know if anyone has looked at this chart. Chris, Tyson, I'm not sure if you guys have looked at this chart, but I just absolutely love where this trade is at right now. We had a very key level of support. You can see price had broken through that support level, came back inside, testing the support. I'm expecting at least a rally to 122. Then if we break through that, 133 is the play to the upside, and that's like 1,100 pips to the upside. I like the play on the Pound Swiss franc, and this is why I am currently right now bullish on Pound Swiss franc. What do you guys think about this, and have you looked at it?
So historically, before Brexit, I would look at this and I would be like, you're crazy to be buying the Pound Swiss, with the equity sitting at all-time highs with all that the junk we've got going on in the market. However, since Brexit, the correlation of risk on, risk off in the pound pairs has kind of broke. It doesn't really know what it is. It doesn't know if it's a risk on pair. It doesn't know if it's a risk off pair. It's not quite sure what it is anymore. It used to be very tied to oil, kind of like the CAD. But now it's kind of on its own a little bit. So with that being said, actually I really like this. This currency reminds me now kind of like of the Euro Swiss or the dollar Swiss, where it can kind of move independently. And so I really like this setup. Technically speaking, I think it's a phenomenal looking setup. I love the divergence you've got played out right there, and I think there's a lot of really good patterns there too. So I really like it.
Yeah, and
all right, good.
Gary, I'm just gonna say I'm right along with you, man. We have Right Trader Max in my trade room deployed long. We're looking for buy trades to go up to 2,200. So between 2,200, 2,250, we see the same range targets, and a break above 2,200, 2,250 opens up the doors to. I know you're looking at 3,000 plus, which same thing here. So first step is to get some solid footing right now and get some runs and traction back at the 2,250. And then it's a matter of if the bulls can break and continue that momentum higher. But yeah, I mean, because looking at the March lows from this year, I mean, we thought that we had massive lows back in 2019 with that big pound sell-off, and we tested those lows again back in March. So I mean, that support level right around 116, 117. I know that it went down as low as 112 with that capitulation move in March, but I mean, look, long term, it's like if you're talking about 20-year lows, 25-year lows, way more interested in buying at these levels for a big payout than I am selling.
Yeah, absolutely. Let's swing it over to what Tyson brought up just now about U.S. oil. What do you guys think about U.S. oil not breaking to $42 a barrel, staying below that level? And that was the gap we had the weekend. That was that area, that key level of support. I call it the breakout there at $42. I think it was $42.44. It's staying at that level, or staying below that level, not breaking through. I'm still anticipating oil to drop back down to $26 a barrel. Just looking at the technicals right here, go ahead and pull it up on the chart here. U.S. oil, there it is there. And now we're at $41.55. Let's go ahead and pull it up here. There we go.
I would look for a really strong rejection right around $43.75, like $43.50, $43.75. That to me is if the bears are going to take action, that's the spot to do it. We've had so much indecision, this drift higher. I think oil's benefited from the weaker dollar. I agree that a correction is likely going to be in play. But if the bears don't show up at $43, $43.50, then I mean, I know we've had this conversation before. It's like, is it fair market to have supply and demand levels finding equilibrium between like $40 and $60 again? That was essentially the range last year, right? We had lows in the 40s and highs in the 60s, and it stayed there all year before we had that crazy move in futures and oil got smashed to negative 30 cents. But we've since come back. The dollar's been weaker, so commodity pairs have been favorited over the dollar. But I just think if the bears are absent around those technical levels, then it's not worth calling the top when it just might blow right through it.
Yeah, I agree. I think I'm not sure if we're forming a top, how a top is typically formed. I think you're right, Chris. I think we could see a spike, a capitulation kind of spike higher to that 43, 44, 45. That's where a top will be formed, and then we'll see. But I think, Gary, I think you're absolutely spot on. I would rather be more short here, and I think there's more room to the downside than there is the upside. And the reason why is actually I just heard an interview on CNBC this morning from a pretty large restaurant owner. And they are seeing some massive destruction in demand and foot traffic in a lot of these restaurants, which tells me people are getting more and more used to either one, we're in this weird spot where we are still very concerned with Corona, which I get, but we're kind of getting used to doing stuff from home. We're kind of getting used to, and I think that travel, I think it's going to take a lot longer for travel, for all of these things and to get back. And if that's the case, then the demand, I think we're at a good spot right now if demand kind of picks up back to somewhat normal levels, but I don't see that happening. So I think we could start to see evidence that we're actually still oversupplied in the market, and that will come through in the next couple of weeks. And that means potentially supply and demand equation says that we should maybe have another flush down in oil. I don't think we're going to go down to zero or negative, but I think that we could start to see some numbers that show demand isn't quite where they thought it was going to be. It's not quite coming back like they thought it was going to be. Supplies, inventories are going to grow again, and we could start to see that flush back down to that 30 level.
Yeah, absolutely. I'm looking at the numbers right here. I definitely think so. Silver, Chris, talk to me about silver, man, because there's been a lot of chatter about silver. We've spoken about gold hitting those highs. What about silver? Now, we all know that when you're heading into a recession, silver outperforms, in my opinion, silver outperforms gold during that period. What is your views on silver right now?
Yeah, I mean, just for the fact that it's a way cheaper asset than gold, the way that silver has rallied, and I've been waiting for 2 years to get silver back up to $20. And of course, I sat in I'm looking at XAG USD, and when it got up to $19.70, I didn't take profit, and it came all the way back down to these March levels. I bought it again at $14, took it all the way back up to the 18.50 highs, the $19 highs. We took out the high. We hit 20 bucks. I took some profit on silver, but it blew right through $20. Now it's at 24 and change. Look, the way that it's rallied, if silver dips back to 20 bucks or dips back to 19 and change, I'll probably buy it, but I'm also prepared for kind of a big false breakout. Like we might go right back into that range and still kind of find, $16 to $14 again. I'm not sure. I mean, I think there's more of a tradable instrument on silver than gold. I'm not going to buy gold at 1,900 bucks. I don't care if it's physical gold. It's like I'd rather buy physical silver. I'd rather melt down my quarters and have silver. But if we have dips, I mean, I could buy it and rationalize why I'm buying it, because structurally, I mean, silver has more upside. I mean, silver can go up to the highs on the chart where we're looking at, $49, $50 on silver. So I just saw something interesting on Twitter this morning. Which comes first? Silver to $50 or gold to, 2,500.
Oh,
and we don't really know, but I just think that silver has more upside, at least when you look at the chart and look left on the chart. But I'm not going to buy at 25. I'm going to wait for a dip. Let's get a sharp pullback to 20 bucks. Let's get a sharp pullback to 16, and then I can talk about buying some silver.
That one's easy for me because I go back to it's the same thing in cryptocurrencies for me. I'm a huge fan of cryptos, but it all leads back to use. Gold has a little limited use case. It looks good. Hey, look at my ring. Hey, look at my necklace. Hey, I mean, but the use case of gold isn't all that great. The use case of silver is huge, especially with the electrification of the world. These electric car makers, these electric Teslas. The technology uses a lot of silver, and there's a huge demand for silver. And so the real use of silver is there. And so I am way more, 10 times more bullish on silver over the next 5 to 10 years than I would be on gold. And I think that's an easy trade. Now, I think that we're getting overextended. However, I cannot see gold at $3,000 an ounce in the next 5 to 10 years. I can see silver at $50 to $60, $70, $100 an ounce in the next 5 to 10 years, just based on the demand factor, just based on the usability factor. And so I would be much, I don't want to buy it here, but if we get below 20, we get back to those towards those 15 levels, absolutely I would be looking to buy silver.
Yep.
Well, you brought a very sore point into your conversation, and that is Bitcoin. Bitcoin's starting to climb out. I told you last week or a week before that, I said I started closing out some of my buys that I had in Bitcoin at around about 9,300, and it's just over the last day it's blown through 10,000. It's at 10,700 right now, I believe.
She's not going to pull back, Gary.
Let's go, Bitcoin.
She's not going to pull. It's all about supply and demand, and the real simple factor of that is this: we historically can dip below mining rates for short periods of time, but the theoretical mining absolute greatest mining rate in the cheapest countries to actually for electricity right now is right around $9,300 a coin. So it takes me about $9,300. If I was paying the absolute lowest amount of electricity right now to mine one Bitcoin, it would cost me about $9,300. And so the reality is we've got, I don't know, 100 million, 200 million, 500 million dollars worth of mining equipment out there and miners that do not and will not allow Bitcoin to fall below $9,300 because they have too much invested in it. So right now, Gary, I think you can maybe buy it at 10,000. Maybe we get back down to 9,500, but I do not expect us to go below 9,300 right now. And if we do, it's not going to stay there long. Think about this: in 3.5 years, Gary, the mining cost, no matter what happens, is going to be near $20,000. 4 years after that, the mining cost is going to be $40,000. 4 years after that, it's going to be $80,000, $160,000. It's just simple math, and it's just simple supply and demand. So people who say it can't go to $1 million, where it's going to cost $1 million to mine in the next 40 years, so it could go to $1 million. Yeah. It's either going to go to $1 million or it's going to go to zero because it's going to cost $1 million to mine.
Yeah, that's crazy. But if I look at the technicals right here, so this is my input on this, right? We're at 10,800 right now. if we do, and I'm watching the daily chart right now, if we do break back below 10,400, I'm expecting it to be range bound and go back to about 8,800, so just below 9,000. Maybe it'll spike down there. But if
Yeah,
it gets
if
down
we
to
get
that
down there,
point,
it'll spike. It'll be a quick move. So having a limit order there, it could absolutely get there, but it'd be a spike. It won't last long, and then it'll pop higher.
yeah, because I did look at the overall setup right here, and I looked at this and I said, hey man, we're in this wedge right now, and in order for it to break out, we need at least test 5 times the tops and bottoms of the wedge right here, and we're still looking for that 5th test right here, and that's why I'm a little bit short on Bitcoin, but we're gonna have to see what it does over
Gary,
here.
The lowest it's ever got, and don't quote me on this, but I believe that the lowest it's ever got in comparison to mining rate was when it dipped down in that first crash down to what was it, 23,000 or whatever from that 20,000. The mining rate at that time, I believe, was right around $4,500. So if it got down, so basically it got about 40% lower than mining rate. So that would be an absolute low, and I would be shocked. Maybe we could hit 6,500 to 7,000. Maybe like that would be like the absolute like biggest low that I could see us hitting. I don't see us hitting that at all, because you got to remember when we got 30-40% lower than the mining rate, that was after a massive historic, like massive run. So I could see us dipping below that mining rate after a historic run. We're just not at a historic run right now. So I think that buying, if you could buy at a mining rate of $9,300, I would consider that an absolute gift.
Yeah. Well, it definitely is there at that level. So we'll see what that does and how it closes out over the next couple of days. But I'm certainly going to make a decision. If it starts getting back down to 8, I might start adding on some positions. See if it does anything at that point. Maybe I'll just go ahead and throw it back in. I don't mind getting in at 8. I mean, I got out at 9.3, so getting back in at 8 or 8.5, it's not a bad deal.
So here's the $1 million question, and this literally could be $1 million question. Okay, we're at 10.8 right now. What if we're at 11 next week? We're at 11.2 next week. We're at 11.8 next week. We're at 11. So we go up, we base, we go up. Is there a time you say, man, I'm just so here's the deal. So I guess I'll answer that question. We should not get higher than 30-40% above mining rate. We should not get lower than 20% below mining rate. We need to stay right around that mining rate. So I would say anything above 12,000, 12.5 is probably overvalued, speculation. Anything below 8,500 is too low.
Yeah. So Tyson, question for you on that. So you think that if we move too quickly, like we had back in 2017, so if we stretch really quickly to $13,000-$14,000 on Bitcoin, you do not see it going back to the 2017 highs at 20K?
So here's the problem with that. A lot of that was sparked by novice speculation.
Right.
And so I'm not sure if we're going to get that novice speculation anymore. What's going to happen is these miners are smart enough where if it gets like 25-30% above mining rate, they're going to dump that onto the market. And so because they're going to be okay with those profits. So they're going to dump that onto the market. And before they were dumping that on the market, and they were having the demand from the novice trader coming in and buying up that demand, so it was just going up and up. I don't think we're going to have that same thing. So what I think is we're going to get about 25-30% above mining rates, and then they're going to dump the profits, and it's going to come down right around mining rates, and then it's going to go back up. They're going to dump onto the market, and what's going to happen is the novice that doesn't know what they're going to do is going to get hurt, because they're going to start buying right when it gets to that 30% above mining rate, and the miners are going to start dumping on them, and then it's going to come back down to 9,500. And then the novices are going to say, man, Bitcoin sucks, and they're going to sell out, and that's where the miners are just sitting, and then it's going to go back up above 30%. They're going to dump. And so I guess the bottom line on this is that's why I'm such a perma-bull on Bitcoin. You can play this kind of game of a range, but the easiest thing for me would be, I think, if somebody just drew a line and said, okay, what's the mining rate? I'm going to sell anything above 25%, and I'm going to buy right at the mining rate, or maybe even 10% above the mining rate. Just play that game, and I think you're going to make a lot of money over the next 5 to 10 years.
Yeah.
So that approach, or is that your way to play a perma-bull game, or is your goal to let mining rates increase over the next 5 to 10 years and see it goes from mining at 9,000 to 10,000 to 15 to 20?
The perma-bull way. So I would do that with any additional capital that I have. Okay. So what I mean is my perma-bull way is I don't sell.
Yeah, I was gonna say I'm essentially just sitting at
I just don't sell.
like 5,500 is my break even on Bitcoin. So
Yep.
the fact that it's at 10 plus right now, it's like I don't care if it goes back down to 5. I don't care if it goes to 100. I'm gonna
So
be
I
in
have
it.
I have a core position that I just don't sell.
Yep.
And so if we go up to 13,000, technically I guess I should sell, but I'm just going to hold it. Any new cash that I get, I'm not going to buy at 13,000, but I'll deploy that cash. If we go back down to 9.5, I'll deploy that cash there.
Yeah, I like it.
Yeah.
It sounds like we're all kind of looking at the same direction for the most part. Gary just has to find a way to get back in.
Exactly.
Yeah.
Don't wait too long.
And to answer your question there, Tyson, if it starts going up, the first dip I get, I'm gonna start putting some money back into it again.
Awesome.
So hopefully we just get that dip, because if it gets up to 20 and I'm not in there, I'm gonna there's a lot of breaking computers and smashing.
I don't think we're going to get up there. That's actually really good, though. I don't see us going through a euphoric rise. Again, you got to remember, I see a double every 4 years, guys. I think we're in the case where it goes 9, 18, 36, 75, 150, and that's really, really good, because that's how it was structured to be.
Sure, absolutely.
Let's do it.
All right. Well, good, guys. Well, that was good conversation. Great stuff, guys. Thank you for popping in and just chatting about the markets, because I think it's important we go ahead and review what's coming up and what are we dealing with in today's trading right now. I think the market's in good positions. I like where we are right now with regards to some of the positions. I like the fact that we're not getting a lot of fundamental moves right now over the last 24 hours. We've actually got a nice technical move, which is nice to see as well. We know we're going to get some fundamentals that are going to support the move that we're seeing, but it's nice to see that our fundamental, or at least our technical setups right now, are actually starting to pay off a little bit. It's been a little bit, more patience that we needed on these trades, but the more patience we had gained on it, the more money we're going to be able to make on it, because it's going to keep us out of the market from going in and out, taking some losses, but really holding on to those positions and managing those positions correctly, so that we can hold on to those positions and not over leverage ourselves on the trade. So it's good to see that, guys. Tyson, Chris, thank you. We appreciate you guys here. Traders, if you like the video, like the content of the video, do me a favor right now. Go ahead and smash the like button. Also, what I'd like you to do, if you have not subscribed to the channel yet, go ahead and subscribe to the channel. We'd love to hear more from you by commenting as well. So go ahead and post some comments in the videos too. We'll certainly go ahead and check those comments out and bring them into conversation in our next videos. So make sure that you guys go ahead and do that. And once again, we'll see you back again next Monday, same time, with the three of us, Chris, Tyson, and myself. And we'll be talking about markets again. So let's go ahead and subscribe, and we'll see everyone back again next week. This is the FX Big Dog and the team saying happy trading. Until next time, cheerio.